What's going on, cash flow veterans? This is John Payne coming at you with another podcast episode. This is episode 17. And this month we're talking about stock market investing, IRAs, Roth IRAs, 401ks, the stock market in general. And then obviously I'm bringing it to you from a perspective of liberty and Austrian economics so far as I understand it. And one of the things that I want to get into, and what the series is kind of titled for this month, the month of August in 2020, is the ideal investment. Thought about doing the perfect investment, but at least I think the ideal investment really kind of gets it across, because I really wanted to switch from everything that I've been talking about so far. And I've had some conversations with different people about this over time. And it's also one of the reasons why I ended up not doing certain things for the thrift savings plan while I was in the military, which is a 401k style of investing for market type stuff. And it's something I've always been very, very interested in, but I really kind of wanted to get into it. So today's might be a little bit of, I don't want to say a rambling, but it certainly isn't going to have the same structure as some of the other stuff, because I really just wanted to dig into where I'm coming from, address some of these ideas, and then I'll be able to have these conversations with a few really good friends of mine that I've had the opportunity to work with in the past at various bases, and just get to know as friends, as coworkers, and they have similar interest in stock market investing through a savings plan. They might even, one of you I know wants to be a financial advisor, a wealth planner for people as well. And so I wanted to get his perspective, because obviously there's some things that I might say that they look at that and they immediately go, I disagree 100%. I think you should do this instead. So none of the conversations I'm going to have with them are going to be got you type arguments or anything like that. But I just want to have an actual conversation about it, because I also think the context of where I'm coming from, the libertarian ideal, the Austrian economic theory, the application of that, I think is very, very important to understand why I would suggest something. And it also kind of shades my view of the economic world that we live in today and where it's going, which I don't think a lot of current practitioners and current financial advisors actually do. So let's just kind of get into it for a second about some of the notes that I have down for this, and just take it kind of item by item. So I think any investing strategy that you need to be employing needs to have a few features. You need to try to reduce your tax liability, because the government's going to come for you in the future as the value of the dollar continues to plummet. They're going to come after more money. I think we will see a wealth tax in our lifetime of the wealthiest individuals in our country. And that also means that you shouldn't necessarily go for, as far as wealth goes, you shouldn't hold yourself back from really applying yourself to being able to do something. But it is going to change our habits, as the laws that get built always do. It also means that you need to be very wary of where fees are going for certain things. And honestly, there's sometimes for a certain item or certain product that I might buy as a means of investing, or in my case, building your own bank. And we're going to get more into the infinite banking concept during this month as well, because that really is going to dovetail very nicely into kind of what I'm talking about. But there are times I will pay more of a fee on a case-by-case basis for something, because there is a problem with compounding fees in some investing vehicles as well. Also, you want to be able to look at what your overall risk profile actually is, what your willingness to risk might be, what your current financial situation actually is. And these are all concepts that financial advisors and financial planners are going to get into. Now, before we actually really kind of get into the meat of some of these notes and stuff, I do want to say I'm not a financial person. I'm not a legal entity. I'm not an attorney. I'm not a CPA. I'm not another type of tax advisor. I'm not a wealth strategist. I'm none of these things. I have just been taking a lot of time to delve into Austrian economics, to look at it from a little bit of a different perspective. And so that's really kind of where I'm coming at it from, but it has informed how I'm organizing my life and the financial attitude of what we are doing in my household specifically. And I've been significantly influenced by Nelson Nash and Carlos Lara and Bob Murphy, who certainly fall in line with the Mises Institute and the idea and economic thoughts of the Austrian economists, the only ones who've been able to not necessarily predict in the way of saying that a stock market crash or a home housing crash is going to happen at a particular point in time, but it is saying that it will happen, and here are the reasons why it will happen. We don't know what's going to push it over the edge. We just know how it's going to play out, and they've been right every single time. And there's plenty of books, and I can put some of those in the show notes. Some of them I'm going to be getting into today. But if you really just want to start delving into the economic side of it, really Mises Institute has a bunch of really good books. And some of the stuff I've already covered, the skyscraper curse, the everything bubble. I mean, these are some very, very basic texts that aren't hard to read. They're actually very engaging, and they explain a lot about how we got to the place that we're in, and not necessarily exactly what we can do about it, but at least, the first point of knowledge is acknowledging the reality of where we're currently at. So with all that, again, this is not advice. This is really just for entertainment and educational type of things. This is more of a thought experiment than anything else. And again, and I'll keep reiterating, I'm not giving investing advice. I'm not giving any of that. These are just questions to really delve into about how we should structure our lives and how we should think about some of the financial stuff that's out there, at least from my perspective and my limited perspective. I'll be honest and as humble as I can about that. So obviously you're trying to minimize tax liability. You're minimizing fees as much as possible. You want to minimize as much of the downside as possible, with making sure that you're striving for as much potential upside in smart investing. So you're judging that risk. Now, one of the things as far as like fees and stuff go is I certainly do. So one of the arguments that's out there is obviously you should really delve into investments, 401k vehicles or IRAs, Roth IRAs that don't have as many fees as, say, mutual funds or other managed type of investment vehicles that are out there. And one of the books that I think really describes this really, really well is actually Tony Robbins' book, Money Master the Game, 7 Simple Steps to Financial Freedom. And he does a really good job of going through and explaining each of these concepts of how much money people are really losing through taxes, because how much money you're losing through fees, because the compounding happens. You're hoping that the compounding happens in your favor, but the more fees that are attached to your annual earnings and the more taxes that are done there as well, the more impact that they're going to have over time. And Jack Bogle, one of the head investors and one of the guys he interviews in the book, if you don't know him, go look him up. There's quite a few others, Ray Dalio and a few others that I like to follow. The Billionaires Investing podcast is another good one that really kind of delves into some of this stuff too. But he calls it the tyranny of compounding fees. And I would also say the tyranny of compounding taxes as well, because even the tyranny of inflation, and we'll get into that in a sec. But fees specifically have that over time. So most of the typical investment of advice is to follow the market, follow the S&P 500, follow the NASDAQ. You're basically following what those are in very inexpensive vehicles. Vanguard financial firm has some of the lowest fees for some of these ETFs. And what's nice about that is because you're saving on it, you're removing the compounding of the fees and maximizing the amount of compounding that is going on with the returns. I certainly understand that logic. It makes sense. So if you are putting money into the stock market, I certainly think that is one of the better ways to get started when you don't have a lot of knowledge. Once you start getting more into actual investing and learning certain strategies, that may not always be the best, but if it's something that you don't necessarily want to think about anymore, that's certainly one of the better ways to go. And there's plenty of people that have shown very consistent results, but it's not necessarily going to make you uber wealthy. And there's also some other potential downsides to it that I'll get into a little bit further on. But there's obviously tax advantages too. So do you expect to be making more money in the future, or less money in the future? And typically people will say that, I'm going to be earning more money in the future. So this is why they tend to go with a Roth IRA today and get charged the current tax rate that they might have today, knowing that they're going to be able to not get charged on any taxes in the future for the Roth IRA, or in our case, Roth TSP. The thrift savings plan has this option for Roth as well to be able to do that. And that's cool. That's awesome. The IRA, on the other hand, allows you to control a little bit more of that income on the other side, to allow you to control your effective tax rate once you get a little bit older. So there's certainly different strategies that can be employed out there. Putting money into an IRA to be taxed on in the future can also decrease the amount of money that you are getting taxed on currently. So if you're right, if you found every other possible tax break that you can find, maybe one of the best things that you can do is actually put money into, an IRA to decrease your overall tax liability, jumping from one bracket to another, depending on where you're at, which makes a lot of sense. One thing that I certainly want to bring up, though, is there's a reason why some of the wealthiest individuals do not necessarily invest like this. They might have started like this at some point in time, but it's not like Warren Buffett himself really is paying a whole bunch of money into this. I mean, he is very active in the market. He's active in not just investing, but he's doing it from a perspective of true ownership of companies and true control of companies. And this is where I start having a little bit of problem with the idea of putting money into the stock market, because the type of stock that you're getting, the common stock that you're buying through these funds, through TSP and everything else, is a way, in my opinion, to socialize the losses for these companies. It helps them bolster their overall financial base of their company, and giving them the room to be able to do other things. But because they work inside the company, and they know whether they're doing well, they know whether they're doing bad. They don't always have to represent it very well. Even, they might even be able to hide certain illegal type of activity that's there for a year, or for whatever the case might be. Not to say that every company out there is doing this, but there are certainly legal ways to be able to kind of move some of this stuff around. And because they're in the know, and the people who have the most control over some of these stocks are able to actually, take the time to get out of one or reinvest back into it to bolster their overall stock price and everything else as well. What I find a little bit galling at times is that if they're socializing the losses, why would, companies and individuals and other politicians and stuff, ask about why we need, basically going in and saying, hey, these vehicles for investing, we want to be able to tax these types of things, but we're also going to make tax exemptions for certain types of things as well. So I kind of think of it like the government giveth, the government taketh away. So just because the government says that it is an incentive for you to put it in, and gives a benefit or a privilege for you for tax shelters or other things like that, that is certainly the map of how to become wealthy in this country. You certainly have to know the taxes, make sure you're legal. That way you're not putting other things at risk. But just because the government is giving it to you as a benefit or encouraging you to do that as an incentive doesn't mean it's the right thing. And that's why when I look at how it socializes the losses, because you would be the last person to possibly get paid if a company like that ever goes under. And you have far less control, if any control. Technically, you're supposed to own a piece of the company. Technically, you own paper that represents some sort of value within the company itself. But then you have preferred stock, and you have all other types of grades for which types of stock people have, what type of ownership people have. And in all likelihood, if a company goes under, you're going to be the last one kind of holding the bag, and you're not going to get anything from that. I remember in 2009, 2010, looking at the reports of how many people having 401ks that needed it to be there no longer had money there because all of the money that they had in those portfolios went down. Now, I also understand the argument of you need to keep the best thing that you could give those investments is time. You keep it in there as long as possible, and then you shift your overall strategy based on your small cap stocks, your large cap stocks, versus the international funds that you're paying into versus the bonds that you're paying into, and you're assessing the risk over a certain amount of time. And I'm really looking forward to the conversation with one of my guests to talk about some of the things that are out there as tools that you can use to kind of track some of the stuff on TSP and adjust every single week and actually be much more active. And I don't like the idea of it being what you would consider a passive investment, where you're not actually taking action and learning more about what it is you're doing. You're just taking money, putting it here because someone told you to. You're going to get a benefit from it. There's certainly a part of me that kind of understands why people would do that. But if you want to be a cash flow veteran, if you want to actually have a vested interest in how you're going to live your life in retirement, you need to be much more active in how you're going about doing that, what you're learning about it, and have your head on a swivel, have your eyes up, go into it with the knowledge. You don't need to know everything, but certainly one that's always kind of digging and looking at how this is going to impact your family overall. And the thing is the government can always come in and change that law back. There's not a whole lot that we can do about that. And that can happen for anything. I mean, even some of the vehicles that I'm talking about for, IBC, they have changed some of those things because guess what? The wealthiest individuals started pumping money into, whole life insurance policies at one point in time because it was the best, safest place for them to do it. But they were dumping all of their money into it on one-time type of investments that was fully funded, and they didn't have to pay anything else for those. Well, they shut that down, and there's certain requirements that actually come along from being able to do something like that. That make it a little bit more difficult in order to do some of that stuff. And again, the government wants its money. It's going to find laws and incentives and do it in a way that is going to benefit the government and the state first, even though it will tell you that it's an incentive for you. The one thing I want you to keep in mind is just because the government tells you it's an incentive for you, tells you that it's a benefit for you, it's not solely because it's a benefit from you for the reason why they're doing it. They're not doing it out of their loving and grateful heart. I'll just put it that way. One of the things I think that I have a problem with for a lot of the large companies and the publicly traded companies that I have is how many of those have government contracts that are out there. And it's always frustrating when I'm trying to put this into the right perspective and not sound like a total douche when I'm saying it. But so I'll just put it this way. So how much of the stock market, the companies that are in the stock market have specified spending for government contracts? How many of them have government contracts, and how much of those government contracts accounts for the overall revenue of some of these largest companies? I'm thinking Boeing, Raytheon, some of these really big military contractors. And I'm also reading a book right now called The War State that's really getting into how the military industrial complex was able to come out of World War II with this huge infrastructure. And it has shaped over the last, 70 years, 80 years, how our country has basically run itself. Everything from what we eat, industrial farming, to the different organizations and agencies that are out there, not forgetting all the spy stuff, all of the interventions we've had all over the country and stuff, but even just stuff in our daily life about how all these agencies that have come about since World War II, because the more that they could grow the size of the federal government, and the more that they could grow the size of the federal government is also correlated to the amount of money that they're able to print. And the further along they're able to get on segmenting the value of the dollar versus the value of gold, the more that they're able to place and inflate the overall currency and money supply that we have. So that's kind of the perspective that I'm coming from when I'm talking about, these private companies or these publicly held companies that are there that are socializing the losses. How many of them also are getting funded by the taxes that you're paying through the government, and then the government is buying these contracts back to these places as well. So not only are you voluntarily putting your money into these because you've been marketed and told to do so, and you think that it's a good idea, and you've come to the conclusion that it is a good idea for you to put money into this. So you're voluntarily doing that, but you're also involuntarily putting money into the government's pocket through taxes. And that money is also going to these companies as well. So to me, it also makes sense that a company like that would go, hey, I'm already getting some of this money that's here. we're going to be able to bolster and actually outcompete our competition because we have government contracts. And then if we can lobby the federal government to make some of these investment vehicles and talk about why it's such a good thing, they can provide we'll say the most uninformed part of the populace, that middle class, and part of the lower class, to go ahead and put some of this money in there. And we'll certainly give them some of the financial incentives, but it will be the leftovers from all of the other preferred stock, all of the other debtors, and everything else that we have in order to do that. And we'll talk about it as if the stock market is the health of the economy. So I think that sums up what I'm trying to say the most when I have these questions in my head that are coming out. So again, TSP, it follows the same process: large cap, small cap, international bonds, international funds, bonds, and has it calculated, or at least categorized, through the 5 different types of funds that are there. And for the simplicity's sake, I think that's smart. I think it does follow the market. I know. Well, one of the funny things I remember a few years ago, I can't remember exactly when it ended, and I'm sure I could just go on Google, and you could too. But if you look up, Warren Buffett's bet, I think it was $1 million bet that he made with, some managed company that was out there, and they decided over a 10-year period they put, $1 million into the stock market, and after they sold all that after 10 years, you'd give it, take that money that you made or whatever, and you'd give it to a charity of the winner's choice or whatever it might be. And so Warren Buffett decided that he would just follow the stock market, your typical 7 to 8% return over a 10-year period. Just follow the market, as any standard kind of investing advice these days is follow, buy an ETF for, the S&P 500 or just your general market trend, and just follow it. Just leave it alone. Don't touch it. Don't manage it. And it kind of goes to the heart of kind of what Tony Robbins gets into, how bad managed funds actually are. They typically do not beat the market, even if they market themselves in a way that tries to show their investors or potential investors that they can beat the market. And in fact, as far as I know, anybody that can beat the market, a middle-class person is probably not going to be able to afford them. A very wealthy person may not even be able to afford them if they're not wealthy enough. Until you actually get priced out of some of those things, you actually don't get access to some of the best investments that are actually out there. And I could do, I guess I could do an investigation, see how far that would go. But it's certainly something that is interesting to go, they don't think people are smart enough or sophisticated enough to know about some of these better investing strategies or have access to people who actually can possibly beat the market, but they allow all these other people to go ahead and do that as well. Certainly don't want to go down like a conspiratorial path or anything like that. But when we're talking about people who have control of the money supply and control of the laws through a monopoly of violence, I don't think that it's much of a conspiracy to go out that they're going to try to control people in whatever way that they can. They certainly need people to behave a certain way if they're going to be able to continue having them produce, to be able to actually gain taxes. There is a problem with that, though, that one of the other books that I have really kind of gets into a little bit. And I'll read it here. So this is Carlos Lara and Bob Murphy, how privatized banking really works. They're integrating Austrian economics with the infinite banking concept itself. So I'm just going to read a little bit of this. So there's a strong connection between economic insecurity and the emergence of big government. The two go hand in hand. The more onerous government taxation, regulation, and inflation become, the more that they cripple the private sector. Yet the process works in the opposite direction as well. As a volatile economy throws millions out of work and the threat of inflation makes it impossible to save, average citizens must turn to the government as their only refuge. The very politicians who have reduced them to such helplessness then graciously offer them security in exchange for just a few more liberties. When the natural blessings of economic freedom are sabotaged, people become desperate. Many historians and economists believe that Adolf Hitler would not have achieved power were it not for the terrible hyperinflation in interwar Germany, which wiped out the middle class. A terrified populace will acquiesce to incredible usurpations of their traditional liberties so long as the rulers claim the new measures are necessary to deal with the immediate crisis. This is the path to despotism. I think certainly with a lot of the coronavirus stuff, one of the most frustrating things for me is how they conflate these issues and make them political issues and the stimulus packages that are coming. And the thing is there's no amount of stimulus that they're going to be able to inject into the economy to forestall what is coming. Bob Murphy and Carlos Lara go into in a series that they have, or at least, sorry, a video that they have on YouTube on how to weather the coming financial storms. I believe it was done in 2017 or 2018. And I'll make sure that the copy of the link is in the show notes for this or whatever. And it's about an hour long, and they go through what their idea is on how to weather the storm, but they also go back, like most of these books do, and explain how we even got here in the first place. And part of it is, again, going back to the idea of investing, is you have the stock market that's supposedly supposed to tell us what the health of the economy is. And while you have Trump or Obama or whoever that's going, look at how great my economy is, look what I have done for you. And the thing is the stock market is not truly the health of the economy. We used to have savings and investing as the ideal health of an individual household. Their ability to save and invest that money somewhere was quintessentially how healthy you could judge a person's home. Not their house themselves, but just their overall lifestyle and everything as well. And I think that's certainly still true today. And I think we find ourselves in a situation where we have to do that. As a cash flow veteran, we're looking for what type of investments that we can make. We're looking to restructure how we go about our day. We're looking to restructure how we think about what we're doing, why we would start a business, how we would progress through doing something like that. That is what the mindset of a cash flow veteran is supposed to be. Now, so what I'm trying to get people to do is to really think about what it is they want in their life, what they see the future of their lifestyle being, and developing money rules for yourself, developing a hierarchy of how you want to go about spending your time, spending your money, spending your resources, spending your labor. And Tony Robbins in his book actually goes into this quite a bit on how to think about things. And I think some of them are fantastic mental exercises because he may not be spot on some of the other stuff that he's found, but he's just kind of reporting what he's thinking about, reporting on what, the conversations that he was having with some of the best minds in the financial industry possible. But he's also, he's a great motivator. And I think that's one of the things about getting a mindset shift is so powerful about his book, and what type of how you want your lifestyle to be, but actually putting dollar figures to that of what your number for financial independence actually is. And I think it's a really good exercise to go through. And I certainly would encourage anybody that's thinking about these types of things to absolutely go into it and really think about it. And before I kind of go on, I do want to talk about what are the best investments that you can make. And again, with that caveat at the beginning of the show, again, it's not necessarily about the dollar amounts, the vehicles themselves, but what I'm trying to say is the best investment you possibly can make, and I have it kind of listed in, priority order for what I think is the first investment that you could do is your skills, your knowledge set. The second investment you possibly can make is the health, your wellness. The third possible investment is entrepreneurship, starting a business. And granted, these are just notional type of things. I could just put all those under one, figuring what is inside immediately your control to be able to improve yourself, to get a mindset of improving yourself every day, to increase your overall value of your own labor and employing it in a way that is going to drive larger margins for you. It's also having the discipline to decrease the amount of expenses you have every single month. My wife and I have certainly had a problem with that over the years because neither one of us knew anything about finances when we even first got together. And a lot of it has been doing a whole bunch of patchwork to get that together, to get us to the point where we are today, enjoying some of the blessings that we've been able to have. But we're still not where we want to go. We still are working on decreasing our overall expenses, at the same time increasing how much margin we have, increasing our overall revenue, a bigger pie, but also living within a means of where we want our life to be. I'm living in the philosophy that I want to have for my life. That's the reason why I got out of the military, is because I didn't feel comfortable making money that way after I had somewhat of a conversion experience with libertarianism, the understanding a little bit more about, anarcho-capitalism and that type of stuff. So as far as what the best investments that you can make as you reframe how you go about living your life, it's also about, opening a business. To me, it's also the infinite banking concept. How can you unlock the home equity? How can you get all these tools in a way that puts you on a trajectory? And one of the common things, and what I'm going to get into with some of the other guests that I'm going to have, is going to be, you're going to, buy term life insurance and invest the difference. It's the biggest criticism of buying whole life insurance policies for stuff. And to me, I don't think that that's quite adequate or accurate for overall wealth planning in general. It's important to note that infinite banking concept isn't necessarily a vehicle. It's not necessarily a particular type of investment, although we're going to explore it this month from that lens. It's a way of thinking. It's a concept. It's a way of life. It's a means to be able to become your own banker, just as Nelson Nash wrote in his book, Becoming Your Own Banker. You don't want to be necessarily, the banker that's working the whole time. You want to be the bank itself. You want to be the control of financing for yourself and possibly financing for other people. Because again, when you look at stocks versus what you own or control, if you're getting common stock through TSP or anything else, you're the last person, and you're probably not getting paid. You're going into that investment knowing that if that company tanks, or whatever combination of those companies tank, and that's why you have such a diverse portfolio to be able to do something like that. You have all those things that are put in. So it's a systemic issue that would cause most of those things to lose overall value. And that's where I actually think we are going, which is why I think there are better vehicles to do that. I don't know when, but I do believe it's going to be in my lifetime. And I believe it's going to be within the next 10 to 20 years of my life that we see some dramatic changes about how the dollar is used on the international stage. It's already lost 98% of its value of gold. If you're indexing it or comparing it to what the value of gold currently is today, over time, just ever since we've, 1913 specifically, once we instituted the Federal Reserve Bank, basically made the central bank of the United States, and then also putting in the income tax. I mean, the value of the dollar itself has just been plummeting. And then Nixon, the biggest scandal that he ever did was not Watergate. The biggest scandal was taking and separating the value of the dollar off of gold. So getting rid of the gold standard. And that just, has set us up for gigantic crashes. And it didn't work for other civilizations, and it's not going to work for us. So again, I'm not arguing against investing per se, but I am trying to have people go into this with open eyes. And I am suggesting that there are, I think, better alternatives to start focus on before investing. It's things that you can control. So again, if you're in a common stock TSP, you're the last person, if at all, to get paid if a company goes under. If you happen to put yourself in a situation where you're an investor, you're actually taking obviously more risk. But if you're doing it through a banking system of your own, and how well you're able to do it, you can finance things for yourself, but you can also finance things for other people in a way. And you get to decide what your money rules are for that, your investing rules for that. How much return do you want? How much are you willing to give that person? How much do you need for them to have down? How do you have them the structure of the company you might be investing into? So you ultimately get to decide on how that happens, and you can have them go over however many hurdles, so long as they're asking money from you. You can go out over all the hurdles to make sure that it is the most comfortable investment you could possibly make. And that is how Warren Buffett has made his money. It's not that he goes and invests in the stock market. He invests in companies. And I think that's a much smarter way to get to, but it takes saving. It takes a basis of saving in order to do that. It takes a basis of you being able to create margin for yourself to be able to save. I don't think that the way that our economy is going to last. I don't think there's any, I think there's an absolute correlation between us being in debt, individuals being in debt, household debt, more than we've ever been, and also the country being in more debt than it's ever been. The fact that we don't have our money tied to the gold standard or any other standard really, other than the petrodollar, that is the only thing that is basically kind of moving us along or moving us forward in whatever weird way that we are right now with the way that our country is going financially. But that's the reason why our country is so far in debt, and we have no choice but to do stimulus. We have no choice but to raise taxes. Our government has no choice but to do any of those things based on the trajectory that it's on. I guess supposedly it could, but the immediate ramifications of actually moving towards a sound money policy are so politically impossible that's the reason why I say that there's no way that's ever going to happen. The pain that would cause people who are currently on some sort of government assistance is going to hurt a lot. And yet they're going to still continue to do something of kicking the can down the road. And the wealthiest, most well-connected people are going to make out. And I'm not just saying the wealthy in general. I'm saying the people who are specifically going with the government, who are advocating with the government. They could be politicians themselves. They could be big tech companies. They could be larger financial institutions, you name it. I still want you to use whatever rules you can to improve your overall income, because the only way to get out of this is to find a way to gain more freedom for yourself. And part of that is financial freedom in and of itself. That's what I want for people to do. That way, when everything else falls apart around you, you have people that you've already been using. You have a system, you have a business, you have other stuff that you can continue to provide value to people. And it's going to change. It's going to shift. You're going to have to move along with however this shakes out. That's my ultimate goal for what we're talking about for investing in general. The last thing I want to talk about is just inflation in general. I'm not going to go super far into it, but I do want to talk about it because we are going to look at the possibility of having, bail-ins, of basically, closing down the banks where you can't necessarily go get your money as certain things are rated. So it's funny to me that all the banks are like, we're FDIC insured. We have this federal insurance from the thing. And the thing is like, even if it's federally insured, what does that really mean? That means if they're going to basically print more money in order to pay for it to insure people for a systemic crash, where are they going to get that money? Especially, do they have the money right now? Well, the answer is no, not really, not at all. In fact, they don't have that money. They have to print that money, which is why we're seeing what they're doing with the coronavirus right now, is why they're having to print so much money to do that. I mean, the FDIC itself doesn't have enough to cover the amount of liabilities that it actually has that say that it's going to cover. I'll just put it this way. So this is from the Everything Bubble, page 218, if you're interested. It is little known fact that the FDIC, the organization in charge of insuring $13.5 trillion in deposits, and we're talking bank deposits. And this book was written 2018, published in 18. Wait on me. Where'd it go? There we go. So 2017. So as of 2017, he's drawing those numbers. So the FDIC, the organization in charge of insuring those $13.5 trillion in deposits, has less than $100 billion in capital available to do this. They have less than 1% of deposits in the U.S. financial system to cover the insurance they say they will be able to cover. That means that literally less than 1% of some of these deposits that are insured, if something happens, can actually be paid. And what I mean by deposit, that's your money that's in a bank. So, and this is one of the distinctions that I want to talk for people about too, is your money's in a bank. You can consider it an asset, but they have physical control and legal control over the money that's there. You might be able to go sue them, but what money are they going to have if that bank happens to go under? They're supposed to be FDIC insured. That way, if something catastrophic happens, the government can come in and bail it out, but the government has less than 1% that it can actually pay right now. Maybe those numbers have changed over the last few years, obviously, but not by much. I mean, the amount of money printing that they're going to have to do in order to do the amount of money printing they are going to have to do in order to create the money necessary to bail out or bail in these banks is astronomical. There's no way they could actually pay insurance on some of these lost bank deposits. There's no way. They can go raid these deposits. The government can certainly go in and try to use some of them, because technically you don't own that dollar. That dollar that you have as an asset is money that is owed to you, even though it's technically considered a cash equivalent. If you don't have it in hand, it's not cash. In fact, I don't even know if we have a 1% of cash in circulation of our overall economy. And why is that? Well, that's due to inflation. And a lot of people have no idea what inflation, how it's calculated. It's kind of calculated off the CPI, the Consumer Price Index. But what is inflation really? And inflation is basically a hidden tax. Every time they print money and every time that goes up, while you think that your value of your home is actually going up, and really it's just in terms of dollars, the amount is going up. Now, the overall value of the home actually might be going up, sure. That can happen, but houses do get older, and so there's a balance there. But as far as dollar amounts, the amount of inflation that actually is occurring versus the amount of actual value that's getting added to that property, we'll see. I mean, it really kind of depends on what your local market's actually doing to be able to actually judge that. But inflation is a hidden tax. So even though, let's say that a lot of people in the lower tax brackets basically get charged almost no tax at all and have a lot of federal assistance where their net federal payments basically would be negative, meaning that they actually get more money from the government than they actually pay in, actually are still getting taxed through inflation. And it's actually disproportionately hurting the people in the lowest tax brackets. So inflation actually hurts those people the most. It's an unfortunate part of that, but if you can add true value to homes and other investments that you have, that's awesome. But that also increases the prices for everything else. If you wonder why the poorest among us are having such a hard time being able to cover bills and why they're screaming for $15 per hour minimum wage laws and all this stuff, it's because they're actually hurting. And it's not because employers can't pay them. It's because of inflation, which then leads to companies not being able to pay people. Or they'll automate it out because it's going to make no sense to pay people when the value of their labor isn't such that it produces profit. It's how companies work. It's how they always will work. Doesn't matter whether you collectively organize and do ownership of a company. And I encourage that. There's nothing stopping anybody from doing a collective ownership of a means of production for a company right now. There's nothing stopping anybody from actually creating their own company as a co-op. None. And it may be very successful, but the one thing that will still hold true is that everybody in there will have to produce more than they actually get. But what would be fair? Well, that's interesting. Hopefully, if you look at the profit motive or the profit incentive to do that, hopefully everybody would be willing to take the exact same in a company like that. If you don't want any hierarchy at all, take the exact same for different types of skills. I mean, everybody from, let's say the manager who's supposed to be directing how everybody is working, from the person that's on the assembly line doing a very simple repetitive task over and over and over again, whether that's taking orders, flipping a burger, or whatever. And you have managers who are in charge of actually making a lot of these decisions. If all of them are actually getting paid the exact same, that doesn't stop the actual labor of being valued differently. But everybody is having to, that's the nature of a company in general. You actually are providing your labor in a contractual agreement. You go in working knowing that because you're working for someone else and you've decided to do that, the labor that you are giving, the value that you are giving, has to be able to create a profit, meaning that they are paying you less than what you're worth, and they have to in order to keep the company going. They have to do that. Everybody there even though their value might be, let's say, $10 an hour, can only be paid for $8 an hour of their value. Because $10 would wipe out the profit motive to be able to keep that company going. Not an individual person. I'm just saying for the company, the entity itself. In order to have the lifeblood of cash that is flowing through it to pay its bills, to pay its people, has to have enough, even if there's a few people, even if you all get to vote on how that extra money is saved, whether that's in cash dividends, whether that's reinvesting, whatever the case might be. And however you set up that democratic system inside there to know whether it has to be unanimous consent or whatever the case might be to move that company forward, everybody there will be able to decide what to do with the profits, right? But what we know about households is that if you try to spend all of the money, all that margin, you're not going to be able to reinvest it and grow as a company either, just as like you're not going to be able to grow as an individual. You have to decrease your expenses and increase your income, which means you have to create more margin. Means you have to create more personal profit for yourself. The same thing happens with an entity, whether it's collectively owned or not. So I got onto that from talking about inflation, and that inflation itself is a hidden tax. As goods and services go up in price, it disproportionately hurts the people who make very little in this world. And then that quote that I gave earlier that talks about government is specifically designed to do that. The Federal Reserve is the cause of booms and busts. It is the cause of inflation. It is the cause of hurting the poorest people among us. So with that, like I said, we will be getting into the next few episodes. I'm going to have some lively discussions with some guests who are friends, former coworkers, about TSP, retirement, stock investing, IRAs, 401ks, plenty of concepts for each of that. I'll dig into more about IBC. We'll talk about what the ideal investment is and whether, buying term life insurance and investing the difference is really a good strategy or not. And we'll talk about a little bit more about that. So this is John signing off for episode 17 for the Ideal Investment for the Cash Flow Veteran podcast. Take it easy, guys.